Now, the price of gold has risen above $5,000 an ounce for the very first time, extending a historic rally that saw the price jump by more than 60% last year.
What is up, everyone? I am here today to talk to you about JP Morgan in today's video, one of the most powerful financial institutions on planet Earth, and why they are signaling that gold will and is replacing US Treasuries as the world's most safe asset. And this is not a conspiracy theory or a Twitter speculation. I have hard evidence that their view on gold remains firmly bullish going into 2026.
Guess as today's market moves indicate that the Sell America trade is back as investors try to minimize exposure to what he calls a volatile and unreliable U.S.
For many decades, treasuries were the backbone of U.S. global finance and central banks, pension funds, and sovereign wealth funds. But when things got scary, money went straight into U.S. debt. We can see now that gold is exploding higher while demand for treasuries is weakening, and that is not supposed to happen. JP Morgan expects the price of gold to go to $6,000 from their $5,000 price target, which has already been exceeded. But do you really know why gold rose so much? The answer here lies with central banks. Central banks are buying gold to diversify from fiat currencies such as the US dollar and the euro.
Generally speaking, you're seeing a diversification away from the U.S., right? Last year, U.S. markets had wonderful performance, but underperformed the rest of the world. And you're seeing a shift in the assets held, particularly, let's talk about money. In other words, when you look at the gold being up 67%, it's not a precious metal that goes up 60%. It was bought by central banks, particularly, but others, in order to diversify fiat currencies, not just dollars, okay? It also has to do with euros and so on. Fiat currencies, which are essentially debt instruments that get monetized, were the big move of last year. The biggest move, bigger than tech stocks, that was the biggest move.
Here, we see the price of the dollar falling, and we see the price of gold rising. The US dollar just hit a 4-year low as the Sell America trade accelerates. The phrase Sell America is used primarily by financial analysts and market commentators to describe periods where investors collectively move away from US-linked assets. This is a very bad thing. However, everyone knows that when you think of America, you think money, and without America, there is no money. The Sell America trade might just be a good way to dollar cost average and repurchase. I know that I would rather have my money in America rather than the second biggest player in the market, China. I feel safer that way, and I'm sure that most other people do as well. However, let's keep talking about gold here. Gold doesn't default, it doesn't get sanctioned, and it doesn't rely on political promises up until now. Central banks understand this, and they've been buying gold at record levels for years. It's not retail speculation, but more like institutional behavior. Many people who were born in the 70s and 80s still say that treasuries are still safe. The US won't default. That is not the argument. The argument is, do investors still believe that the treasuries are the best place to hide, or has market sentiment switched?
China, India, and Brazil have reduced their holdings of US Treasury bonds over the past year or so.
The answer is no. This does not mean you dump everything and just start buying gold bars. It means the old 60-40 model is under direct pressure. It means bonds may no longer protect your portfolio the way they used to. And it means gold, it's not an option anymore. It's a strategic investment into your future. Every time gold replaces government debt as the preferred safe haven, it happens during periods of extreme leverage and geopolitical stress, such as the period we are under now. An example of this is when it happened in the 1970s after Bretton Woods collapsed. It happened again in the late 2000s after the financial crisis, and now it's happening again during the largest debt expansion in human history. Gold is quickly replacing treasury bonds and is the biggest safe haven in the world. And by the time everyone agrees, the move will already be over. First, Donald Trump on Friday nominated Kevin Warsh as the next Federal Reserve Chair. Warsh, who will succeed Jerome Powell as the head of the U.S. Central Bank, is seen as pragmatic, independent, and has his own personal voice within this crisis era experience. Markets interpreted this move as more orthodox and unlikely to yield to calls from the White House for drastic immediate rate cuts, demands that Trump has been repeatedly directing at Powell. Warsh's nomination sent the US dollar higher, and in contrast to investors' bets that the Trump administration would tolerate a weaker currency. This is not the case. Among the short list of Fed chair candidates, traders view Warsh as the most hawkish on inflation, lifting expectations of tighter monetary policy that would bolster the dollar and pressure gold, which is traded in dollars. The recent fall that we had will be short-lived, and money will continue to flow back into gold and silver. That is what the majority market sentiment is, and although we may see certain dips happening 5 to 10% around the current price value, current market sentiment is saying that the price of gold and silver will continue to rise over the next year. Here is what major headlines are saying. Analysts at JP Morgan are mentioning to buy the dip and dollar cost average gold. This is not financial advice, but I think that all the facts all point to securing the safe haven asset. Large banks are relying on it, and I am treating this as a buying opportunity. Thank you for watching this video, and let me know in the comments if you think that this rally will continue or not after this recent plunge. Take care.